Hello and welcome to the penultimate Fit Finance Sessions Advent Calendar window opening. And today I'm going to ask Tom about residential property. It seems to be the one thing that we haven't covered so far in this topic. I live in an igloo, but Tom lives in a house made of bricks. Tell me about it. Is it a good investment?
Yeah, so buying residential properties is different to what we talked about before about commercial property and buying sheds, warehouses, shopping centres and things like that. Residential property is just like the property you probably live in, or as long as you're a human and not Santa. And essentially you get a rent paid by the tenant, and you hopefully get some capital growth as well. The main reason to do that is it provides diversification, and also by using a mortgage you can leverage your return. So you only have to put X amount in to buy the house, and you borrow the rest. Obviously that comes with risks, but it allows you to kind of supercharge your returns. It's quite common on property, but quite often seen as most people wouldn't borrow a lot of money to go invest in the market. So whilst it can seem quite normal, there is a perception of little risk when actually you are amplifying the returns, but also the opposite way around as well.
Sounds interesting. And it's one of those things that I suppose everybody knows how to invest in if they've all got their own houses, but I'm sure Tim knows some decent reasons why you wouldn't go towards property investing. Go on, Tim, fire away.
Yeah, well, I think the obvious one, as Tom's already mentioned, really is the leveraging aspect to it. So you're borrowing to buy an asset, whereas the other types of investments, the more liquid investments, market investments, and that sort of thing, normally you're not borrowing to be part of that. So there's some inherent risks straight away there. I mean, I think the most prominent one other than that is of course tax and the taxation rules around second homes or third, fourth, etc. Rental properties. I think over the last 3 or 4 years, really, the tax book has largely just been thrown at landlords to help first-time buyers get on the market. But just to throw some rules at you. So if it's not your primary residence, then you're initially going to be paying a 3% surcharge of course, on stamp duty on the purchasing side of things. If you do have a mortgage against the property, you're not able anymore to offset that cost against income and then pay the tax on the difference. Basically, you pay tax on the full income, and after that has been paid, then you've got to service the debt anyway. And then, of course, when you come to sell the property, if you've had a nice capital gain over the years that you owned it, you're paying an additional 8% capital gains tax, whether it be 18% for basic rate payers or 28% for higher additional rate tax payers. So there's an 8% surcharge effectively over any other type of CGT bearing asset. So you're sort of being taxed extra, sort of at the beginning, during and end. So it is, you have to be careful with regards to the tax planning when you get involved in that sort of thing.
Fantastic, really clear. So it's an interesting investment, diversifies away, but comes with a whole heap of tax rules and legislation around it that doesn't make it as necessarily as nice as it might otherwise have been.
Exactly.
Thanks very much, chaps. And tomorrow it's the final window opening before the big day. Can't wait. See you then. Bye-bye.